Okay, hello everybody, and welcome to my webinar called Hypothetically Speaking. I'm Kevin Davey, and I'm glad you all could make it here today. So hopefully you'll learn some interesting things and save yourself some money down the road with what I'll tell you today. So during the presentation, if you have questions, feel free to send them my way. I might not see them until the very end, or I might not answer them until the very end, but I will try to answer all the questions. We have about 15 minutes or so allotted at the end, so that's what we'll try to do. All right, well, let's get started. First, I'll just go over the agenda. For those of you who don't know me, I'll give you a brief introduction to some of my trading history and some of my background. Then we'll get into the meat of the presentation of how hypothetical results can fool you. I mean, we've all seen trading results that looked great and always wondered if it was really true. And there's a lot of little traps that people can use intentionally or unintentionally to make hypothetical results look good. So we'll go over some of those today, and you'll be able to avoid using them. Then at the very end, towards the end, I've got a special offer on a couple of the systems I offer and I trade, open code, and I think you'll be pretty amazed at the offer I'm going to present to you today. It's really a nice offer. And then, like I said, we'll have about 15 minutes at the end for questions and answers. So if any time you hear me breaking up voice, or it's too loud or too soft, just type something in the chat window and just say too loud, too soft, something like that, and then I will try to fix it. Okay, as you know, I've started doing webinars in the past month or two, and all of them are free, and as long as you're on my email list, you will be notified of all my future ones. I also try to put them out on Twitter as a tweet, but the people on the email list always get first priority to join, and some of them are pretty close to filling up. So it's good for the people. If you're not on the email list, go to my website, kjtradingsystems.com. You see it at the bottom, and sign up for my email list, and you'll get advance notice. So you can kind of see some of the ones I have coming up, and some I didn't list that were from a user survey that a bunch of you participated in a few weeks ago, and I thank you for that. So I'll go through some of those topics. So really trying to get just different trading topics of what people want to hear. Next week, I'll actually be doing what I call a general question and answer session, where basically I will just have a real basic format, and I haven't really decided how that'll be, but it'll basically be user questions the whole hour. So, as long as it's legal to answer the questions, I will try to answer, and to the best of my ability. And it's a good chance for you to get some questions answered that you might have always wondered about, but maybe been afraid to ask or didn't know who to ask. So I think that's coming next week. You'll see an email on it soon. So who am I? Well, first, right at the top, I'm a full-time trader. And I put that in capital letters because to me that is a big deal. I'm not a system seller as my primary career or vocation. You could probably guess if you've attended any webinars or anything, articles or anything I've written. I'm not a real good salesperson, so I tend to let the results speak for themselves. And most of the people who sell systems out there are really good salespeople, and they have to be, because in most cases they're selling something that isn't real. But it's a good question to always ask when you look to buy a system, or talk to somebody for advice, make sure you're talking to somebody who actually trades and not just what I call hypothetical trader. And there's a lot of them out there. Boy, you go to internet forums and bulletin boards, that kind of thing, and boy, there's people making money left and right every day, and you wonder how they can do it. And my conclusion is they can do it because it's not real money. And I meet very few losing sim traders, and I think that says something, and I think that's what most of those people are. But I've been trading futures for about 20 years, and most of that was part-time. The last 4 years I've been doing it full-time. And I finished in the World Cup of Futures Trading Championship 3 years in a row, either in first or second place. I finished second place twice and first place once. And each of those years I had over 100% annual return. And that's a real money contest. And you're up against some really good traders. I happen to know 4 or 5 of them that I regularly Skype with from all over the world, and these guys are really good traders. And so if you can do good in this contest, it says a lot. And this was the same contest way back when that Larry Williams turned $10,000 into 1.1 million. So it's a pretty well-known, it's the most well-known, best well-known trading contest out there. And then in 2010, if you bought Brent Penfold's book called The Universal Principles of Successful Trading, it's a really good book. I was profiled in there as a market master, and I actually wrote a couple pages in that book. So, and then if you didn't hear of me from any of those things, you might have seen me quoted in the Wall Street Journal or Investors Business Daily, or I was interviewed by Fox Business News a couple months ago or a month ago, and you might have seen an interview with me on Forex TV. So my point is, I'm not well known, but some people in the business know who I am and what I do, and my record's out there, so it's easily verifiable that you can find out what I'm telling you is pretty much the truth. All right. I always put up this disclaimer. It's required by the U.S. government, and you can read it. It basically says, don't trade with money you can't afford to lose. I'm not making any specific recommendations in this webinar. And then the paragraph in red is probably the most important one. And it basically says hypothetical results have limitations, and it lists some of the things that hypothetical results, the problems with them, but it's a government-mandated warning for a reason, and it's because of people taking advantage of hypothetical results and showing results that no trader trading real money will ever obtain. And that's something I try to do in my own systems. I try to avoid that, because obviously I'm developing systems for myself. I want systems that reflect reality. So keep that in mind with hypothetical results. So I had sent out a survey a couple months ago, or a month ago, I think, and got a lot of good answers about hypothetical results. And my favorite one's the one right in the middle with the gentleman singing, where he used a profanity, so I can't repeat it here, but backtests are some kind of swear word, and that pretty much sums it up. That backtests, which are hypothetical just by the sheer nature of them, can be very fraudulent. Some of the other things people said, commissions were ignored, or people curve fit, or they did selective backtesting, and we're going to go into some of those, each of those actually, and then we're going to go into some that very, very few people, if any, answered. So, well, first, before I go into these 8 traps, the golden rule of hypothetical results, and if you take away nothing else from this presentation, just remember this. If it's too good to be true, if something looks too good to be true, it probably is. And there's a couple of reasons for that when you think about it. No one's going to sell you the Holy Grail. You know, the Holy Grail is this trading system that works in all markets, under all conditions, and basically is like a printing press. Just makes money. And why would they? I mean, if somebody truly has a trading system like that, that is above and beyond anything you've ever seen and makes millions of dollars a year trading one contract with no risk, why would they sell it? They'd have no reason to sell it. They'd be much better off just trading it themselves. So that's the first reason. But that doesn't mean that there aren't good systems out there. Like, for example, I sell a couple systems that I'll talk about later, and I don't think they're unbelievably great systems, but they're good systems. But you'll look at them, and you look at the equity curve, and you'll see drawdowns, and some fairly significant drawdowns. So it doesn't mean that it's not a good system. It just means it's a realistic system, but it's not the Holy Grail. So again, if you see something that looks too good to be true, it probably is. For anyone who can't hear, I'm going to type a quick note here. Okay, I'm back. So too good to be true. That's the golden rule of hypothetical results. And like I said, if you take nothing else away from this presentation, just remember that. So, you know, hopefully just with that government warning and kind of the too good to be true statement I told you, it's obvious that hypothetical results have limitations. But hypothetical results are always going to be here. And to be successful, you need to recognize the ways that hypothetical results can fool you. And that's what we're going to talk about now. We're going to talk about some different ways, why they're bad, and how they can be avoided. And somebody asked what I would consider too good to be true. What combination of return, percent return, and drawdown? Well, I can tell you that a lot of professional commodity trading advisors out there, they aim over a long period of time, over, let's say, 3 to 5 years, a return to drawdown ratio of 1. And that's considered acceptable and pretty decent. So, for example, let's say you wanted 20% a year annual return. That would mean over that same period, let's say it's a 5-year period, that you have to be willing to endure, and you probably will endure, a 20% maximum drawdown at some point. And if you don't, if it's, let's say you see some hypothetical results that are a 10 to 1, where the return's 100% and the drawdown's only 10%, I would tend not to believe that as a result. So 1 is good. A return to drawdown ratio of 1 is good. 2 is even better. I've seen sometimes 3. Usually that doesn't last, but if you can find a system that has a 2 over a long period of time, that's really good. And even 1 is good. So hopefully that gives some idea of what would be good and what wouldn't. Okay, continuing on. One important point. You know, you'll have people say, "Hey, this is," and I say it too, I trade this with real money, so my results are with real money, blah, blah, blah. Even if somebody tells you that, if they try to imply that their results are not hypothetical, don't listen, because look at it from your perspective. Anything that's not in your account that you can't personally see, you have to treat as hypothetical, because even if some person out there is trading it and you see his audited trading results, that does not mean you will get the same results. He could have a better broker or a co-located server that gets orders in a little quicker, or he could be doing a lot of different things that make his results possible that might not make your results possible. So the point is, treat everything you see, whether or not it's written down or audited or whatever, as hypothetical. Certainly this business has seen, just in a couple months ago with PFG, that people can Photoshop statements. The founder of the PFG brokerage got away for years, apparently, with photoshopping bank statements. So, treat it as hypothetical, because there's always a chance that whatever somebody tells you, and even if you think it's real, it might not be. So as long as you realize that, you'll be much better off and much more skeptical, which is always a good way to go. So let's look at the 8 ways that hypotheticals can fool us. Okay, a lot of people got this first one, almost half the surveys, and this is curve fitting over optimization. There's a lot of different ways to do it. With trading software, it's ridiculously easy to curve fit results. You run a moving average system, and you run every combination of a long and short one from 2 to 200, and you just pick the best one, and guess that will give you a good equity curve. Almost always happens that way. I used to do something similar with my own money when, like Money Magazine or Kiplinger's magazine would come out with the best mutual fund list, and which I've reprinted here. And I used to say, well, if it has the best one-year return or whatever, I'll buy that one. And almost always, after I'd buy it, they always went down, and I could never figure out why. And it took me a long time to really figure it out, but what I was doing was really optimizing. I mean, I was taking the whole universe of mutual funds, picking the best one over a certain period of time, and then trading it, and, buying it. And, well, of course, the best one today might not be the best one tomorrow, and it probably won't be, because a lot of these tend to just revert back to an average. So sometimes they'll jump out in front, people will jump in, and then things don't go as well. So that's one way of curve fitting. Obviously the other way is with the trading software. So it's a danger, and it's not just with the trading software, and I guess that's kind of my point. Here's a trading software example. I'm sure you've seen ads with results that look like this, where it's almost a perfect straight line up. Some little drawdowns, but wow, those aren't too bad. If you saw this in some kind of direct mail piece or an internet site, you might think, wow, this is really good. But again, too good to be true, usually will fail. And I don't have what this system did afterwards, but I can assure you it went the opposite way in real time. So what I did was I created this one in about 5 minutes, optimized it, and that's the results you see. And so when you start going with that in real time, it just falls apart. And that's how you curve fit and over optimize, and that's what it looks like. It doesn't have to look that good, but a lot of times it looks even better. I mean, I've seen people sell things that said no drawdowns ever, which is just totally ridiculous, but people fall for it. So watch out for this curve fitting. Here's an example of the opposite of too good to be true. This is one of my trading systems. This is actually my Trender trading system. And you can see the results are fairly decent, both in development testing and also in real time, but they also have drawdowns, and they're fairly significant drawdowns, and I've circled those areas. And that's an important point. I don't try to hide that in what I show because I want people to know that there are extended periods of drawdowns, and they can be deep. And I would look at this curve and I would think it looks good, but it doesn't look too good. It doesn't look unbelievable, I guess is the point. So that's kind of what it goes back to. If it's unbelievable, chances are it was probably curve fit or over-optimized. And if it looks believable but good, then maybe, maybe it was done the right way and maybe it is achievable. You don't know. Okay, so why is this trap of curve fitting and over-optimizing bad? Well, the future never really repeats itself at all. And, I gave you the mutual fund example where what was best over the last 5 years isn't necessarily going to be best over the next 5 years. How can you avoid it? Well, if you create your own systems, if you like developing your own trading systems, I know a lot of you out there do, there's a couple points. Limit the number of variables you have, limit the number of rules you have. The less the better, the harder it is to optimize. If you think about it, you could create, the worst case, a rule every day of your history, and it would be August 20th, buy, August 21st, sell. You could just custom fit it and you get a great looking equity curve, but that wouldn't work going forward. So that's why you want to limit the variables and rules. You want to use what's called walk forward testing. If you don't know what that is, go to my website and you can find information on it. You can also do a Google search for it. That's important when you do any kind of back testing. If you don't want to do this walk forward testing, make sure you have out of sample data, and that's data that you do not optimize with. That's pretty important too. And the last point is, before you commit real money, you want to do what I call incubate it, which is basically try to simulate as best you can real-time performance, but not with real money. And it takes a little while to understand how to do that correctly, but it could save you a bunch of money by not letting you trade until you actually see this work in real time. And the same holds if you're going to buy a system. You wouldn't want to buy a system today and start trading it with real money tomorrow. You would want to spend a month, maybe 2 months, whatever you feel comfortable with, trying to evaluate it and see how the system works in real time. Doing that alone will probably save you, I would say, 75 to 90% of the time from curve fitting, because curve fit systems aren't going to work in real time. So if you do that without real money, you'll be able to save yourself a bunch. Other things you can do, you can avoid those too good to be true products, ask a lot of questions, research the reputation of the seller. There's some websites that do reviews of trading systems, and you can kind of get an idea if the system's any good. And if they have money-back guarantees, try to take advantage of that. If they're there for a reason, and if you don't like it and if things don't work out the way you think, it's a good reason to use it. Okay, hypothetical trap number 2. About a quarter of you got that, which kind of surprised me because I would expect more people would know that. Commissions and slippage not included in performance results. And what I show here is one of my systems, the SFE. It's a mini S&P system. There's a mini S&P component to it. And I put the blue curve is without commissions, and the pink curve is with commissions and slippage. And basically the performance goes down by about 34%, which over the course of, looks like about 12 years, is an extra almost $40,000 in profit that's gone. So there'll be people out there who will show this result without commissions and slippage, and your results are going to vary quite a bit. I mean, right there, you've taken a 30% hit. If you are dealing with a scalping system, you probably will turn a positive-looking system into a negative system. And the most common thing people say, or a developer or somebody will say as well, your commissions are going to be different than mine, so therefore I don't include them. That's just a cop-out. Commissions for most people are going to be around $5 to $6 per round turn per contract. Not going to be a whole lot different. And if they can't put that in there, to me, it says they're hiding something. And why is it bad? Well, first, it gives a false sense of your profit and loss. All your statistics are off, and trades that will be losers in real life look like they're winners. And it leads to over trading. And the reason is because if I create a scalping system and I don't include commissions and slippage in it, and I assume I can get these perfect fills and don't have to pay commissions, I will trade in and out 100 times a day, guaranteed, because there's almost no way you can lose. But once you include commissions and slippage, then maybe you want to take like 2 trades a day, maybe, and so that's a biggie. People don't even think about that, but it definitely leads to over trading. So how can you avoid it? I would just ignore systems where commission and slippage is left out. As a worst case, you could add it in yourself. Make sure you include 1 to 2 ticks slippage, which is for the ES, it's $12.50 to $25. For gold, it would be $10 to $20. You can always use more and adjust it later. And you'd adjust it by using actual data, and that's when I develop systems. I have not a library, but I have a pretty good idea of what slippage would be in most markets, and it a lot of times turns out that the slippage I assume is actually not as bad, but that's a good thing, right? Okay, hypothetical trap number 3 is selective backtesting. There weren't many people who mentioned this, but this would be just taking a backtest over a certain period of time. So you can see, for example, here's a backtest for 5 months. Hey, that looks pretty good. That's even with some drawdowns, that's still a pretty good equity curve. But you can see it was only from January 2012 to May of 2012. Here's what happened afterwards. So that chart you just saw is kind of scrunched up here. After optimization, it basically kind of flatlines, but you notice the drawdowns become a lot more severe. So that's an example of why selective backtesting can get you, or a small backtest period. It's a dangerous way to test. I think what you want to do, if you usually want to test 5 to 10 years of data, or as much good data as you can get your hands on a lot of times. And it's bad because you could actually, what happens is your system can tune itself to the current market or the market over the past couple months. But as soon as that market type changes, you're in trouble. This is a big problem with Tradestation, because they only offer 6 months of tick data, and a lot of people want to develop tick systems. Well, you can do that, but the next 6 months aren't going to be like the last 6 months. I can pretty much guarantee. I don't know what they're going to be like. But when you try to develop something over a short period of time, you run the risk of just this selective testing and good results. So like I said, look for 5 to 10 years of a back test, and I personally would avoid anything under a year. I can't imagine a situation where that would be a good idea. Maybe if the contract was brand new and you thought it was worth doing, but if you have the data, use it. But the flip side to that is just because it's a long back test, a long period, doesn't mean somebody can't curve fit. That's back to the trap number one. So somebody can still do that. Okay, the rest of the traps I'm going to go through, a lot of times only a handful of people, or sometimes nobody, actually brought these up. So these are ones you might not have heard of, but they're pretty important. So the first one is limit orders, and there's an assumption a lot of backtest engines use when they evaluate a strategy, where they assume limit orders are going to be filled as soon as the price is touched. Well, anyone who's traded with real money can tell you that there's no way that you get filled consistently at an extreme price. It's very hard to do. It can be done. I've done it, but I don't do it as a matter of routine. Usually, to get a limit order filled, your price has to be exceeded by a tick, and then you will be filled, and that's because of the bid-ask spread. So what I look for, and I put this up in this chart, look for, if you see trades superimposed on a chart, look for situations where the buy or sell is at the extreme of a bar, because that means the person bought the exact low of the bar or sold the exact high. And it's amazing how many people out there, how many vendors sell systems that have this. And it's truly, for the uninitiated, it's a real wake-up call, because this will turn a winning system into a loser in no time. And it also shows that the person developing it probably doesn't trade, because nobody, unless they're trying to con people, nobody would do that. Nobody would actually show results like that. As I said, it's completely realistic, and that's why it's bad. And it's pretty easy to avoid it once you know it. If you're testing with your own software, there's usually options with most software. Tradestation has it to fill limit prices only if exceeded. You can also look at the price charts with the trades on them, and if you see that, I'd run. The problem is, if you tell a developer that, and I've done this, where I've actually said, hey, there's no way you get these fills, and they come up with all sorts of excuses of, well, you just make an adjustment and with your slippage, and then you're good to go. Well, no, that's absolutely not the case, because these situations, when it occurs, is the difference between a fill and no fill. It's not a fill and a slightly worse fill. It's either you get filled or you don't. And it's something really to be aware of. Okay, number 5. This is a good one for scalping systems. Use this trick, and also some software when it recalculates, and you might turn your trading software off thinking certain trades have happened, then turn it back on, now different trades have happened. And usually, a lot of times that's due to what I call the backtest path assumption. And I'll explain it real briefly, where if all the trading system has is that bar without information inside the bar as far as price moved, what it usually assumes is if the open is closer to the low, it will assume the price opens, goes to the low, then moves up to the high, and then exits at the close. That may or may not be what happens. You might get the exact opposite, which is what I show below, where actually it entered at the open, went up, then went down, and then went back up again. And depending on the sequence of those prices, you might actually get a loss, hit a stop loss before you hit your profit target. Now the backtest software will actually tell you the exact opposite. It will give you a winning trade, and when in reality it's a loser. So it's kind of a trick nobody really knows about, or really pays a lot of attention to, unless you look at the data in a lot of detail. So obviously, assuming if the backtest software assumes the wrong path for the price, you're going to get bad results. It's that old garbage in, garbage out type situation. So you can avoid it by just being really careful around scalping systems. Tradestation software has something called look inside bar back testing, which you can actually test down to like a minute level or a tick level. That would be good to use. And I mentioned scalping systems tend to use this or tend to fall victim to this. And scalping systems in general are pretty popular with people, but they don't work. And part of the reason is there's actually 4 of the traps we just talked about are kind of built in a lot of times to these scalping systems, where they use this path assumption that you get limit order fills with them. They remove slippage or commission or both, and they usually curve fit. So if you see a good scalping system, I'd really be wary, and it's because of these reasons. Okay, number 6. This is, some people still do this out here, where they show the results of closed trades only, and they kind of leave their losers kind of off to the side and buried. But if you're familiar with American baseball, there was a baseball player named Lenny Dykstra who in the 80s and 90s played for the Mets and the Phillies. After he was done with his baseball career, he ran an option picking service that actually Jim Cramer actually was just astounded by how good he was. And he claimed he had over 90% winning picks. Well, what he was really doing was his losers would kind of get buried and he'd never close them. And what he'd usually report were just the closed trades. And he was only closing winning trades. So, of course, his winning percentage is going to be huge. And, by the way, he's in prison now for some other things, but kind of gives you a good idea of the kind of person he was. This one is, I've seen this in quite a few ads out there where they only talk about their closed trades. And it's really misleading because obviously, if you just bury your open trades that are all losers, you don't know what you've got with this system. Chances are it's probably a losing system, actually. And the industry standard, and this is hedge funds, commodity trading advisors, they have to mark to market every day, which is your net equity, includes open and closed trades. So that's what you got to look for. And if you see something where it looks like just closed trades are counted, that's your warning sign with this trap. So once you know this is out there, it's pretty easy to find, but a lot of people don't even know to look for this. Okay, trap number 7 is volume. And there's couple of ways this comes up, with either illiquid markets or just trading huge size. So, for example, if somebody's selling the greatest orange juice system out there, well, just realize that orange juice is a very thin market, and the fills they assume might not be the fills you get. And I just pointed out an example of, I think this was a couple of weeks ago, where there was a $300 drop per contract in 1 minute, which is pretty big in orange juice. With no volume, it just dropped. And so somebody might say, oh, hey, I sold up at this way up, and just volume-wise, there's no way they could have done it. And, obviously this just leads to erroneous results. Another one was this one hooked me in years ago, with somebody showing a sugar chart of how if you just did the simple buy and add to sugar, you would have made millions. And the tricky part with it is all you had to do was buy 5 contracts every week. And, wow, that sounds kind of simple. Well, by the end of it, you had almost 200 contracts. You had $8 million in profit, but you also had to endure over $1 million in drawdown. And, hypothetically, yeah, this could have worked, but there's almost nobody, especially a smaller trader, who could have done that, consistently added 5 contracts and sweated out that big drawdown. So the point is, either fills can be impossible, or emotionally or mentally, the performance is just something you'd never be able to do in real life. So how can you avoid it? Look for systems where everything's just based on single contract performance. That's one good way, where they're not pyramiding, because pyramiding can mask a lot of issues. And also just try to avoid thin markets, orange juice, lumber, things like that. Doesn't mean you can't trade them. I do. But, don't be plunking down a lot of hard-earned money for a dream system in orange juice when, it might just be a so-so system. And one way you can always see that, and, ask yourself, is this market a good one or not? Just look at the size of the bid-ask spread. If the bid-ask spread is big, then you know it's probably a thin market. All right, the last trap is you need a huge account to trade it. Here's an ad I found on the internet, and it basically was a trading system, and it trades 150 different instruments. And I'm like, wow, no matter what kind of equity curve you show me, you got to have the money to trade 150 instruments, right? And they might show you making $1 million a year, but you might need a $10 million account to trade it. And related to that is the fact that most traders that have small accounts will fail. And there's a couple of reasons. One, you're probably over leveraged trading a small account. 2, you don't have any diversification. And 3, your ability to withstand a drawdown or a string of losses is pretty small. So, as an alternative, you could always look at the E-minis, the micros, and, that might help. But you really need to know the historical drawdowns. And chances are you're going to need more money than you think you do. And again, why is it bad? It's because you're not going to be able to withstand the drawdowns unless you have a big account. And how can you avoid it? You can estimate the capital required. I've listed a couple different ways here. I'm going to have a webinar in a couple weeks on a bunch of different ways of how to properly size an account for a certain trading system. So, there's different ways to do it. It's what you feel comfortable with, but the key is not to trade too small. You don't want to get wiped out. All right, so summary. What kind of traps did we talk about today? Well, we talked about curve fitting and over-optimization. We talked about not including commissions and slippage. We looked at selective back testing and the limit order trick. Scalping systems with the recalculations and the path that the price takes. Now that you should look for void systems that just show closed trades. Hopefully you got a sense for volume for the illiquid markets, and also to look out for the account size that you need to trade something.